Hello, in this video, I'll teach you about the best awesome oscillator indicator strategy for day trading stocks, cryptocurrency or forex, so stick around till the end of the video to understand the strategy. The Bill Williams Awesome Oscillator Indicator is a technical analysis indicator developed to determine whether bullish or bearish forces dominate the market. It assesses market momentum in order to identify potential trend direction or trend reversals. The market momentum is assessed using a combination of shorter and longer time frame simple moving averages. Or to put it in another way, it compares recent momentum to higher time frame momentum. The Awesome Oscillator is calculated as the difference between the most recent 5-period bar simple moving average and the 34-period bar simple moving average. The indicator, however, uses the bar midpoint value rather than the closing price. Although the Awesome Oscillator formula appears to be complex, it is actually quite simple, and it's as follows. The midpoint value is equals to the bar high minus the bar low divided by 2. Now the Awesome Oscillator will be the simple moving average period of 5 minus the simple moving average period of 34. The indicator is plotted as a histogram in a box at the bottom of the chart, with the histogram bars in either red or green. With some trading platforms, the lines can be red or blue. When the last price's midpoint is higher than the previous bar midpoint, the histogram turns green or blue. And when the last price's midpoint is lower than the previous bar's midpoint, the histogram turns red. In simple terms, the bar will be green if it has higher value than the previous bar, and red if it has lower value than the previous bar. The zero line, around which the indicator oscillates and moves between positive and negative value, is another component. If the indicator values are above the zero line, it means that the shorter period is greater than the longer period, and vice versa. If the shorter period is greater than the longer period, the indicator will be below the zero line. When the histogram moves above the zero line, it indicates that the bullish forces are driving the market. Whereas when the Awesome Oscillator value falls below the zero line, it indicates that the bearish forces are driving the market. Before we go to our strategy, let's check out the different common Awesome Oscillator indicator strategies used by traders. The first common strategy is the Awesome Oscillator zero line crossover strategy. A buying opportunity alert occurs when the Awesome Oscillator indicator crosses above the zero line, indicating that the shorter momentum is increasing faster compared to the long term. Like in the chart below, we can observe the market was initially in a downtrend, and the Awesome Oscillator was below the zero line. When it crossed over the zero line, we wait for a price action pattern to form or a suggestive candlestick pattern, and in this case, we get a bullish hammer candlestick pattern. We get an opportunity to enter into a long position targeting a 1:2 risk-reward ratio. A sell opportunity is detected when the indicator crosses below the zero line mark, displaying that the short-term momentum decreases more rapidly than the long-term. Like in this other chart below, we can see the market was on an uptrend, forming higher highs and higher lows. Then a downtrend started to form. We wait for the Awesome Oscillator to cross the zero line from above, giving us a sell opportunity. We just don't enter into a trade blindly. As always, we check for a suggestive candlestick or a good price action pattern. And in this case, we can see an engulfing bearish candle. We go into a short position, targeting a 1:2 risk to reward ratio. If you want to learn more about the bullish and bearish engulfing candlestick pattern trading strategy, I have a link in the description. You can check it out. The second strategy for the Awesome Oscillator is what we refer to as the Twin Peak Awesome Oscillator strategy. A bullish twin peak occurs when you have two consecutive peaks below the zero line, with the second peak higher than the first and followed by a green bar. Remember that the trough, which is the pullback between the two peaks, should remain below the zero line. Secondly, we have the bearish twin peaks, which appear when there are two peaks above the zero line, with the second peak being lower than the first and followed by a red bar. In addition, the pullback between the peaks should stay above the zero line. As always, using only one indicator in trading will not be reliable. We'll add other indicators, and in this strategy, we will involve the 14 and 7 exponential moving averages. On the chart below, to take a short position, we wait for the 7 EMA to cross the 14 EMA from above, giving us a signal for a possible trend change to the downward side. Wait for the awesome oscillator to be below the zero line, and we take our trade targeting a 1:2 risk to reward ratio. On this other chart, we can see the 7 EMA crossing the 14 EMA from below, giving us a signal of a possible trend change to the upside. We wait for the awesome oscillator to be above the zero line and take our long position, putting the stop loss just below the swing low point, targeting a 1:2 risk to reward ratio. We can exit the market when we see this bearish twin peak being formed, which suggests a downtrend might start. Watch my next video on Heikin Ashi trading strategy best for scalpers and day traders. If this video has been helpful, remember to like, share and subscribe to this channel for more future videos like this. Till next time, see you.